Hello everyone, and welcome to your Masters in Healthcare Management and Leadership. Today we're speaking about Module 4. Module 4 is about financial management in the healthcare sector. Today we're here with Mr. Joseph Spiteri, who has vast experience in the financial services and will be using his knowledge to share with us how we can manage finance in our healthcare organization. So, let's get right to it. Thank you for being with us here today.
Thank you very much for being here.
Good. Just to ask you, as an introductory question about finance, what is finance all about?
Well, there's a lot of, let's say, misconceptions. A lot of people think that finance is purely about, financial statements and about money in general. Well, actual fact, that is true. That is partly true, let's put it this way. Because finance as a subject is actually broadly put onto two different levels. One of them is about the raising of finance. Mm-hmm. But the second level is about the management of finance. And when we say management, it goes into a vast array of different aspects. Now, this is a general rule on practically all sectors, be it in the private sector, be it in the public sector. Obviously, the objectives and the targets within the private and the public might be different because of obviously the scope and the strategy that has been taken. But they're practically on the same wavelength, they're on the same level, okay? Now, when I talk about the raising of finance, we have to understand that this can be varied. There are many different methods of raising of finance. We can talk about the whole scope under very simplistic methods. Let's give an example where somebody's opening up a lemonade stand, okay? Even at such a minute or very, let's put it this way, insignificant type of an operation, you still need a financial structure. Why? Because in order to reach your objectives, you need the right resources and the allocation to the right tasks and the duties there. Now that's one aspect. The other aspect is the management. Now once you are capable of raising the finance, now again, the simple example about the lemonade stand, you're forking it out of your own pocket or you're borrowing money from your relatives or from a friend. You still have to have the right acumen and the right appreciation of how you're going to be utilizing those funds and those resources at your hand, because it doesn't only have to be money, it can also be other resources as well to reach your objective. Now, it can go, finance is associated with money. But it's not only associated with money, it is associated with a number of different aspects. And the heart of finance comes from the macro and the micro economical theories. I mean, I'm not saying that it's purely economics, but again, it's a hybrid between accounts and economics. Okay, so when we go into the aspect of the raising of the money, it depends on what type of business you're talking about. Let's say in the healthcare management, in the healthcare sector. In Malta, the healthcare sector, or let's put it this way, the vast majority of the healthcare sector is managed or administered by a governmental organization. So the method of raising of finance is completely different to, say, a private clinic or a private hospital, because again, the administration is different, and in some cases, while the same level of service is being provided, the way it is managed could be different. I'm not saying that between the difference between the public and the private sector that there's difference in the way they look and they administer, but the objective could be a little bit different. So when we talk about finance, we are talking about the administration of and management of assets and liabilities as well. So what we have here is we have people who are being given the responsibility or the stewardship to administer these assets in the most ideal way. Now, when I say ideal way, it depends on the strategy that is taken. So if you have a government-run hospital, again, the main purpose there is to give the right level of service to the people that require it. In a private sector, say like in other countries like the US, their healthcare system is different than in Malta. Why am I saying this? Because they do have basic public service of healthcare service. But when it comes to the private sector, then that's a financing arm that completely is different. And they have a complete different structure and a complete method of raising funds and of obviously the administration. Okay? see. Yeah, a very important point here is that we have to also distinguish between accounting and finance. Now, this is a very common mistake that is taken by many people who are non-financial or accountants. The reason being because they think, oh, they're all numbers and they all refer to financial statements or they refer to numbers. But in actual fact, there are two different things. Primarily on the way they look at finance and accounting and the information that they have in front of them. With regards to finance, finance is more about looking forward. Once you have the assets and the financial resources at your hand, it's very important to evaluate and come up with a plan to implement and utilize those resources that they have at hand to reach their objectives and their strategies. With accounting, it's more about presenting the information that they have, which is practically historic, in the most correct way, so people in the finance sector can evaluate further how well that these companies or these organizations are functioning. Okay, so when we come to accounts, there are accounting standards which have to be abided by, because that is the only way how we create a standardized level of information. Now, when we come to look at finance and accounting, and I want to emphasize on accounting because we have to appreciate that it is through accounts and the financial statements that people properly evaluate how the performance of an entity, be it a private or a public entity, a sector company. The financial statements go back and have been a requirement ever since the dawn of civilization. I mean, there are documentations that go back to the Mesopotamian Empire, which refer to accounts. I mean, okay, they didn't present them as we know them today, because the accounts that we know today and the accounting structure originated from the legal perspective, from notaries. If you go back to the 1700s and the early 1800s, it was in Scotland that you actually found a standardized way of accounting. It was from the notaries that actually the concept of accounting as we know it today have come up. But the importance of maintaining information about your resources has always been around. I mean, you can, as I mentioned, you can go to Mesopotamia, you can go to the Romans era, where the Romans had very, very sophisticated, let's put it this way, accounting systems to account for the resources that they had. When I talk about resources, not just about financial resources or gold or precious metals at that point in time, but they also had regarding wheat and grain. We have to understand the concept of how society was at that point in time. So the importance of having a yardstick or a measuring stick to managing your resources has always been a part of our civilization. Even on a personal level, our budgeting skills, our maintenance of our accounts, our bank accounts, these are all forms of some type of a record. So while they are not, how can I say, considered as accounting statements, they are a part or an important part of the information that is presented in financial statements. Okay.
You've mentioned quite a bit about financial statements. Could you explain a bit more about the broad aspects of what are financial statements, what's it all about, or what are they representing?
Yes, as I pointed out before, financial statements come part and parcel of finance in general. As I said, accounting is based with past information as a benchmark to past performance. With finance, it's the finance people that take that information and manipulate it or use it to create a plan to gauge and direct an organization towards its objectives. Now, let's assume that a company has come up with a project and they're developing a new product. It is through their financial statements and their financial calculations that they can gauge whether it is, how can I say, profitable, or in that the value of a company has been maintained. Now, the series and the set of financial statements are crucial in the evaluation of a company's performance and an entity's performance, even in healthcare. It's a very important thing. Because obviously, like any type of institution, be it in the private and the public, you have to see the viability of certain services. Okay, this is a common thing throughout all sectors, be it in finance, be it in banking, be it in construction. Everything has to have a price and everything has to be calculated because, again, you have to evaluate whether it's worthwhile to do something. Okay, the broad series of statements that make up a set of financial statements are, broadly speaking, about the balance sheet, the profit and loss account, and the statement of cash flows. Now, when I talk about balance sheet in accounting terms, this document has changed its name into a statement of financial position. Now, in a nutshell, what does a balance sheet, let's talk about balance sheet at this point, represent? It's a financial snapshot of the position of the company or the entity at a particular point in time. So it is like saying, what do I look like in the morning? And you take a picture of yourself, and what do I look in the evening, or a year, or 2 years after? And that's what it's representing. It's saying, listen, what is the composition of its assets of a company's assets and liabilities, and how has these things changed? In essence, the balance sheet is split up into three different sections. You have the You have the asset part, you have the liability part, and you have the equity part. Now, the accounting equation is based on the balance sheet, where we have, and this accounting equation, which is fundamental when you come to evaluate a company, especially on the balance sheet level, is that the assets less the liabilities will equal the shareholders' equity. And when we talk about equity, we're not only talking about the contribution that equity or shareholders have provided to a company, but it's also the claim that a shareholder has on a company. Now that means that if a company has been profitable and has not distributed its profits in dividends, it will have reserves. So the shareholder has a right to that holding, that asset. Well, let's put it this way: the financial valuation of that company. Let's go back to the asset point. Now, the assets are split up into two different categories. One of them is the long-term or fixed assets of a company. These type of assets are much more of a long-term. Actually, on a technical level, we're talking about assets which have a lifespan of more than one financial year, beyond the financial statements that you've presented. So we are talking about we're talking about brick and mortar, we're talking about property, we're talking about vehicles which are used, we're talking about things that are there from a hospital point of view, from a healthcare point of view. We're talking about CT scans, we're talking about beds, we're talking about operation theaters. We are talking about all these different aspects that have a lifespan that can be utilized by the organization for a very long period of time. Obviously, there are matters which will condition what are the value that we present on our balance sheet when we talk about depreciation. Depreciation is something which is used to equally distribute the value of a fixed asset or an asset over its effective lifespan. So you can have a fixed asset that is converted into a short-term asset based on the lifespan of this asset. Now, these things change over time, and again, there are macro issues that will affect the value or the underlying value of an asset. So I'll give it two examples. When you talk about fixed or long-term assets or fixed assets, you can have a building which costed you, say, 100,000 euros to build, or dollars or whatever, say 15 years ago. But by time, there are two different aspects that come into play. One of them is the usage of that property, which could devalue certain aspects of that property. But then you also have market forces that come into play, which when an accountant or the financial people within an organization are recalculating or revaluating these fixed assets, they have to see the market forces that affect that value of the asset. So there could be situations where a property, say, is acquired at 100,000, but that over time that will go up to 200,000. The question comes here: what happens to that 100,000? We haven't sold it; it's still there, absolutely. But that let's say increase in value is converted into what we call a reserve, and that goes into the equity part. Now, if you have to come and sell that property and you liquidate that property, then that asset is converted from a fixed asset into cash. because that is the conversion there. And again, what happens is that you have a conversion from a fixed asset to a current asset, but also you're eliminating the reserve and it's going back into the cash position. So the other example is, say, like a CT scan. Over time, that will depreciate. Why? Because of its usage, but also because of technology. In healthcare, and like in most science-oriented businesses, technology and the development of technology plays a big role in the method of how things are accounted for. So just say you bought a CT scan which is 15 years old. Over time, besides the usage and the repair and the maintenance that you have to put into play to maintain it, then new technology comes by and it replaces the efficiency, the effectiveness, and the usage and the purpose of the usage of that asset. So we have to keep these things in mind when we come to evaluating how the asset part. Coming to the current assets, as I pointed out, are something which can easily be converted into cash within one financial year. So what we have there is and debtors, people who owe money to the organization. We have cash items, we have stock levels in the case of hospitals and healthcare operations. These are the material that are used in operations, in the maintenance of clients. I don't know, intravenous bags, it could be needles, it could be swabs. These are all the items that are frequently used. So those are the stock levels that are used in the operation. When we come to the other side of the balance sheet, which is the composition of the liabilities and the equity position of a company. And the liability part are the obligations that the organization we are operating with has with third parties. Now, this can take also a long-term liability and a short-term liability, depending on the category of these liabilities. The long-term liabilities could be borrowings. It could be bank borrowing. It could be bond borrowing, financing through bonds, through financial instruments, which again have to be valued accordingly because based on accounting standards, which I will explain later on, play a very important point on the overall valuation of the organization. As I pointed out, the equity part of the financial state of the balance sheet is that you have the share capital, which is the risk capital that is put into an organization, and shareholders who have the right to the profit of the organization, which is pictured in the profit and loss account, which I'll explain later, is the risk takers. These are the people who actually put the risk money into the organization, and it's up to them, obviously the management of the organization, which will increase the value of a company, increase its profitability, and again, the shareholders will obviously appreciate that. And obviously, as I pointed out, there are short-term liabilities, which the short-term liabilities are those liabilities that have to be honored within one financial year. And it can go from like overdrafts, which are technically short-term lending, to a conversion of a bond, which is due within the year. To other liabilities, like salaries, unpaid salaries, for example, go into the liability part. So in a nutshell, that's what the balance sheet is all about. Coming to the P&L, to the profit and loss. The profit and loss is much more like a bench or a checking of the profitability of the organization. So in the P&L, or the statement of not financial position, but of comprehensive income, yes. In that statement, what we have there is how well did the company, perform during that financial year under the financial year you are looking into. And in the sections of the P&L, you have the sales or the turnover or the amount of income that you've generated and over the financial year, and then you have your costs. And after you deduct your costs, you will have your gross or net profit, depending on what we're talking about. And I want to distinguish between operating costs and non-operating costs. The operating costs are directly linked to the operation of the delivery of the service that you're offering or the product that you're offering. But then there are the administrative or the financing part, which have to be distinguished between your core operational aspect. In a hospital or in a financial, in a hospital or healthcare institute, the aspect there is that when it comes to operational, obviously it's the cost directly linked with the actual execution or the provision of the service. So if we're talking about operations, for example, it would be actually the salary of the doctor who's actually, and the nurses that are assisting in the operation. So that would be a direct cost there. When it comes to the indirect costs or the administrative tasks, we're talking about the people who are at the front desk, the people who are managing the organization. So it's very important, and the important part of this is that when we come to evaluate between 1 year and the other, you're trying to find out where the efficiency or the lack of has turned out. So we call that variance analysis, when you compare 1 year and the other on a financial level. The last more important financial statement in the core set of financial statement is the statement of cash flow. Now this is a very interesting financial statement, which I personally really appreciate, and not a lot of people talk about. If you look at the financial, the markets, when they quote companies, they don't look at the cash flow, or they rarely look at the cash flow. But actually the cash flow is at the heart of the well-being of an organization, because you can make a lot of sales, you can actually operate on a lot of people, but if you're in a private sector, if they don't pay, you're not going to be able to honor your obligations with your employees, with the people who are you're supporting your operation. That's just to give a simple example. So if you are not in the cash flow statement, you are what you're actually doing is you're analyzing where the cash flows are coming into. So while you're bringing in the cash from your operations, where are your cash flows going to? Is it going to pay off finance? Is it going to pay operations? And if so, have they changed? Have you have they changed to a certain amount that you haven't anticipated? Like just say if salaries go up unexpectedly, the cash flow statement will actually pinpoint where that thing is going. And from a cash management perspective, which is a crucial thing in management in any organization, questions have to be asked. And not only questions, you have to anticipate in the future how you're going to be managing that.
Okay. Would you say there are any rules to construction financial statements?
Absolutely. Again, as I talked about in the beginning, there are, in order to have uniformity throughout sectors, and especially this is very important from an investment analysis point of view. If you have standardization of preparation of accounts, of financial statements, that will make it easy for people who are not involved in the administration of the company to actually gauge the wellness of an organization and how well management is administering the assets and the liabilities that they have at their disposition. So the importance of the accounting standards and standardization of accounting practices is crucial. Now, a question which will obviously be raised is, but does every organization report the same things? It's actually not. Every sector has key areas, and there are actually accounting standards which actually address certain areas of different businesses. Now, it's very important why these things are, there are accounting standards which have come around and have been around for us for a long time. Now, there are different entities, organizations around the world which, how can I say, have their own accounting standards. To talk about, broadly speaking, before, if we talked about this subject 25 years ago, you would have different countries which have different accounting standards. So this did not facilitate international investment. Once there was a consolidation of accounting standards, and when I say a consolidation, in today's world, we have the IASC, which actually has provided a global standard for accounting standards. Now what you have is a vast majority of countries or jurisdictions that refer to international accounting standards. But then you have the US, which they have their own accounting standards, or GAAP, and US GAAP, which is very similar. And actually, ever since 2001, under the famous Norwalk Agreement between the U.S. accounting authorities and the international accounting body, they've come into an agreement to actually finalize and roll out harmonized accounting standards throughout the world, and this has actually helped a lot of international finance. And if you look at financial statements, both in the U.S. and in Europe and in Japan, you will have a continuity of accounting standards. So these are crucial. Now, all these accounting standards cover a noticeable amount of aspects, and the most important thing is about valuation. This is a crucial thing, and of late, a lot of emphasis has been put on to the valuation of financial instruments. And just to mention it, IFRS 9 has revolutionized how financial instruments are accounted for. Now, you're saying, but from a healthcare perspective, how important is that? It is important because, again, you have to understand that you can have a very, very good, well-run health organization, but if the valuations of certain assets take a dip because of adverse financial market implications, it could actually affect the wellness of an organization. I mean, this is something which has to be pointed out by non-financial people. They have to appreciate how important it is to understand, not to go into technicalities of how accounting standards are set or what is the determining factor of how something is valued, but you have to appreciate how important it is and how it will affect or could affect you, as it is in the case of, as I gave the example before, of the CT scan, which obviously doctors or people who are specialists in that area can highly appreciate how important it is to have a fully functional or state-of-the-art CT scan. It's also very important to understand that that thing could be devalued and the level of service could be affected. But in the same time, if you have a financial liability that was used to finance that CT scan, the method and the linkages between the value of the liability that the organization might have can have implications on the running of the hospital, because at the end of the day, if your liability affects your operation, you have more obligations and you can honor it, your healthcare clinic or your healthcare institution might not be able to work. So it's very important that we keep that in mind.
Okay, all right. And what about the utility of the financial statements? How would we use it? What are they telling us?
Well, the very, very important thing is, and this is a common thing which I meet. People who are non-financial people are sort of, frightened, or think that, well, I have to do a lot of calculations, and I don't know how to do it, and I don't know how to interpret them. Actually, it's very important to understand what those figures are telling you. It's like going to a doctor and asking them to do a blood test, and in that blood test that you have a number of different criteria which will tell you the level of health you are in, or if there could be a problem. In financial statements, the numbers in themselves could mean nothing if you don't know how to look at them and understand them. So you can have a positive profit figure for 1 year, but it could mean that from the previous year, you're actually not doing as well. Now, if the objective of the organization, the strategy, is to increase better sales, for example, and from 1 year to the other, your sales have gone down, you have to be able to interpret and understand. Now, enter the concept of ratios. Now, ratio in itself is a pure calculation. It's just a number over a number usually, and you relate to each other. But in actual fact, there are ratios which are actually evaluating a number of different aspects of an organization. It could be from asset efficiency to profitability to appropriate profitability to asset utilization. I've mentioned these things, but more importantly, how well the company is being administered. Now, the ratios can actually tackle different aspects. I can talk about profitability. I could talk about working capital management. And all these things, while we usually hear a lot of P ratios, if you look at CNBC or you look at Bloomberg TV or you access some type of a website, financial website, they refer to these different ratios. But people are looking at them, might not understand them. Not only do they not understand them, they don't know where they come from. So the linkage between ratios and financial statements is a crucial aspect. And you have to appreciate how important it is to link the two together and understand how to utilize them. Now, for an organization such as in a private sector, profitability is obviously a very important aspect. From a public sector perspective, from a healthcare perspective, the important thing is the maximum utilization of an asset. Well, I'm not saying that in the private sector it's not that way, but more importantly, you have obligations to the general public because the funds are coming from taxation, and taxation has to be justified for further investment, for example, in the future. Now, the aspect of ratio analysis is, again, a very important management tool to gauge the efficiency and the effectiveness of the management approach and the strategies that the organizations are taking.
All right. And how would you say that they're used in the decision-making and evaluation process?
Absolutely, because again, the figures in themselves and the interpretation will gauge how efficient and effective the management is being taken out. And again, the redirection of an organization could be based on the figures that are being presented. Okay, so you can have a situation where, say, a hospital is going to acquire a new or develop a new wing. You have to understand and anticipate from previous information that you have and your projections to see how well equipped you are and the justification of that investment. Mm-hmm. Now, the ratios in themselves can say, okay, just say if we open up 2 new theaters, and in those theaters we're going to be catering for like a special type of illness that has not been around, and that in order to cater for the previous cases, we are, the entity, be it a private or a public, are forking out a lot of financial resources to cater for that service because it's crucial. So again, you have to look at the efficiency through, well, obviously through financial statements, but the ratio analysis in itself will go into the actual specific evaluation. And that's a crucial thing, to be able to interpret them and to implement them in your strategies.
Okay. My next question is about budgeting. What is it all about?
Well, it can be extreme. It's very important in any aspect of management. As we can easily understand that budgeting in itself is putting a plan into financial, figures. And obviously, like, we can talk about creating a new strategy about, say we're talking about new level of service. What you have to do is you have to justify and create a budget to support those arguments that are being played, to actually say, listen, this is reachable, this is attainable, based on the assumption that you've made. It's a very important thing, and based on the resources available to deliver that objective. Now, you will find people who talk about budgets, projections, or anything that is forward-looking as something which is a fuzzy science, because actual fact, we don't know what's going to happen tomorrow. We can wake up and things change. But at the same time, you need some type of a barometer. You need something to guide you at any stage. Now, I'm not saying that a budget in itself should be set in stone, because again, things change over time. But fundamentally, people who are involved in the budget process have to have enough acumen and appreciation of the situation that the organization is in, and where the objectives have to, the objective of that project has to come into play. Now, the budgeting process is a very, very important thing. It is an organizational task. People think that it's purely a finance task. Is not true, because the finance people might be coordinating the preparation or the implementation of it, because obviously it's through the budgeting process where you ultimately could have allocation of financial resources to different projects or to different departments within an organization. Not only that, there are different levels of budgeting. There are actually organizational budgets, but you can also have departmental or unit-based budgeting. But obviously this rounds up to the grand objective of the organization. So it's an organizational thing, and people who don't think of that in that way are bound to miscalculate and misinterpret. So everybody has to contribute in this budgeting process, and it's usually a very lengthy process. And it doesn't come, you don't just arrive to a budget within a very short period of time, especially if it's an organizational budget, and especially if we're involved with a project where you have like projects. This is the most interesting, interesting task. You can talk, when you talk about hospital development, for example, You can actually do a budget, but actually the cost overruns could actually be tremendously large. And this is a crucial aspect about how well the people who are administering those securities, or sorry, those assets, and the assets that they have, the financial resources that they have, in the right way. These are crucial aspects, and this could actually. I'll give you an example. You're developing a hospital, for example. Now, in the hospital, you will have you'll have a plan. You would definitely know all the technical aspects you have required to actually set that into play. But you also, in order to reach that, you have to have the financial plan to support it. Now, when we say the financial plan, you have to actually gauge the right resources that you have to, associate with the project over the time span of the project. So if over time you notice that you're not reaching the objective or you're within your budget, you have to take corrective measures. Now, it depends on what type of corrective measures you're talking about. And this is the beauty of budgeting. It's more about the skill of managing and anticipating and controlling the manner of how an organization or a project carries on. And that's why certain people have to change their attitude toward different situations. That's why you have changes in the hierarchy in an organization over time, because you have to adapt. You have to be capable to adapt to the situation you're in.
Okay. And my last set of questions relate to risk analysis and project evaluation. If you could start off with, what is risk?
Well, that's a very, very important thing, because what we just talked about budgeting just before. But risk is a part of everyday life. We all, even on a personal level, risk and risk assessment and risk evaluation is something which is constantly going on within ourselves. It's a human thing. It's a natural thing. Okay, even in the animal kingdom, there are rudimental, very basic levels of risk assessments. Okay, now people think of risk and they think negative. Okay, in actual fact, risk is about the probability of the unlikely or the undesirable outcomes in an action that is taken. But in actual fact, in the financial world, risk management is actually crucial, not only to gauge the negative outcomes, but also to take the opportunities or to take the right decisions when the situation arises. Now, in risk management, there is a multitude of different aspects, and we can talk about this for forever. You can actually do a PhD in risk management, just to give you an idea. But it's very important that even in every different aspect, even at the lower levels of an organization, the appreciation of risk and how risk rolls out and how it affects an organization, and even in their tasks, have to be identified. I'll give an example. I gave you the example of the CT scan. Now, if staff are or an X-ray machine, if the staff are on location and they realize that there are situations where the machine might not be operating correctly, the implications there is that the organization will not be able to give the right level of service. There will be complaints. There will be downtime. There will be people who are waiting for the service, and there will be a number of different things. This is a similar situation both in the private and the public sector. Now, this is not warranted. Now, what risk managers do, and people who do risk assessments, they have to understand and anticipate these unlikely or unpleasant outcomes so that they can counter these situations. Now, in risk management, there are practically 3 different levels of how you manage risk. You can either do nothing and let it happen, which in some cases actually could turn out the right way. Okay?
If you're lucky.
Yes, definitely if you're lucky, because again, luck is also plays in any type of decision we take. You can actually mitigate risk, okay, or you can control risk. And how do you risk mitigation? In a very simplistic example, is to control and have the appropriate risk management structures, or you can actually outsource risk management. And how do we one very simple example about risk, outsourcing risk management is by taking insurance. Because you don't eliminate, now this is a very important thing. When people think about taking insurance, you're not eliminating yourself from risk. What you're doing there is you're just you have like a backup, like a second line of how can I say, of action in the eventuality that something happens. Now again, if something bad happens to your operation, your hospital floods, your clinic it catches on fire, it doesn't mean that you're, the next morning that something happens, you're going to be up and running. It's not that easy. But the risk, the passing on part of the risk to somebody else will definitely help your management of adverse situations. Now this is where the how can I say, the knowledge of people who work in the respective sector comes into play. There are calculations that we are required. There are decisions to be taken. But the people who are working in the sector can appreciate how important the decision to take certain adverse or how can I say, corrective measures or have a plan of action just in case something bad happens is crucial. We can understand a power cut can happen in a very crucial operation. Now, we're talking about lives here. We're not talking about, I don't know, an ice cream stand, for example. Now, risk management comes into play. Why? Because not only do you have to assess the severity of the unlikely, the unpleasant situation, but you also have to plan and allocate resources, coming to the budgeting part, to counter these things. And you have to anticipate this. These are very difficult things to do, and it comes through experience. And that's why certain organizations, be it in the healthcare sector or not, have to refer to consultants who know how to address these things or have the right level of information. Because kindly note, any type of management decision needs the right level of information. And that's a crucial point.
All right. Well, that pretty much sums up the questions I have for you today, Mr. Spiteri.
Thank you very much.
I'd like to thank you for your time today.
It was a pleasure.
Thanks. So there you have it, dear students. Today we spoke about financial management, and our main topics included, well, an introduction to finance. We spoke about the financial statements and their utility. And we spoke lastly about budgeting and risk analysis. Thanks.